Hello, I'm Deb from Invest Property Answers. Today I want to talk about three taxes that affect an individual investing in property and how to use two fundamental principles that will make you tax efficient whether you have one investment property or 100. There are three taxes that affect an individual investing in property: income tax, capital gains tax, and inheritance tax. You want to be tax efficient across all three of these, so you need to be thinking about structuring your business properly using the two fundamental principles: never sell your investment property, and as the property goes up in value, increase the debt against it. I cannot repeat these statements enough, and I can see those eyebrow raising. Here she goes again. Yes, really, increase the debt against the property, do not pay it off. So with these in mind, the first tax I want to look at is income tax. Let's imagine there are two identical people. They have the same job, same income, and are buying identical property investments. A three-bedroom, semi-detached property next door to each other. In other words, everything is the same in their lives. In this example, they each buy the house for £100,000 with a 75% loan-to-value mortgage of £75,000 with a deposit of £25,000. Here, let's assume the rent is £650 per month with the mortgage based at 4.5% of £75,000, which was around about £281 per month. Maintenance on a 3 to 4 bedroomed house we know costs on average £1,000 a year, so a month will be £80. You must have building insurance on your investment property. I use £240 per year as my guide, so this is £20 per month. And finally here, the letting fee is 10% plus VAT, which works out at £78 per month. So once you take the rent away from the costs, you end up with £191 rental profit per month. Now let's imagine person A, Alex, ignores the two fundamental principles and pays the mortgage off. Let's look at what happens. Alex's mortgage is now zero, but the trouble is this gives her an extra £281 per month profit. That is £281 extra income a month. So what is the reward the government gives Alex for paying off the mortgage? Well, for Alex, the reward is she will be required to pay more tax. All because she paid the mortgage down, she pays more tax. So what about person B, Betty? She follows the fundamental principles. She doesn't pay the mortgage off. She has an interest-only mortgage, so she doesn't pay it down at all. She does have a different problem, though. To be able to use the fourth profit lever of property, Betty puts her rent up 3 to 5% every year. This means the rent over 3 years has gone up £670 per month, £690 per month, and finally here, after 3 years, it is £710 per month. At this point, if she is not careful, she will have an extra £60 per month profit, which she will need to pay more tax on. However, also after 3 years, maintenance will go up with inflation to say £90 per month, offsetting some of the rental income increase. Plus, the property will go up with inflation, so it will be worth more. At this stage, Betty can go back to the bank and borrow 75% of the new value of the property and draw out equity. The mortgage payment goes up, however, this offsets with the rent rise. In other words, after 3 years, Betty's income goes up £60 per month, but expenses go up about £60 per month too, so her net income rental profit stays the same. If you follow the rule that as your property goes up in value, you increase your debt against it, you too will stay income tax efficient. For further tips and posts, go to Invest Property Answers on YouTube, Facebook, Instagram, and LinkedIn. Not wanting or being able to buy investment property at present is not a boundary to profit from property. Investors love working alongside my property portfolio business, receiving strong guaranteed fixed percentage yearly returns on their money. If you'd like to learn more about Invest Property Answers projects, why not get in touch via info@investpropertyanswers.com. We love to help investors get a great return on investment and look forward to hearing from you.